So, Tony, that's a perfect segment to really what I was going to ask. Can you give us a little bit of color, maybe a couple war stories about where you've been engaged and some of the different uh, areas people both pre and post liquidity event where they got themselves into trouble? What are kind of uh, in broad strokes the circumstances that got them into trouble?
So first, let me just pigeonhole myself into the IRS. The IRS is a huge organization. It's about 80 to 90,000 employees. It is broken up into divisions. And the two main divisions are small business and large business. So large business is any taxpayer, and typically it's medium to large businesses with uh, uh, income higher than 10 million a year. So you could see that that segment's pretty large. And then everything below that is going to be the small business sector. So most of my career was in the large business. And in large business, because the dollar amounts are so much higher, typically they were sophisticated enough to hire advisors. And when they did, it usually worked out a bit better for them because you plan well, you do better. You mitigate the risks. So in those instances, one of the cases that I had, which I can't name the taxpayer, uh, one of the taxpayers that I assisted in involved a very, very large, wealthy individual who started a retail company. And years, and this was very, very thoughtful planning, years before the company went IPO, many years ago, the taxpayer was advised and did expatriate. That is, gave up US citizenship, moved to another country with a much lower tax hit, and planned the exit to mitigate US tax far in advance of the actual IPO. Now, the law changed, and that's Code Section 877 and 877 Cap A of Title 26. The law has changed. So now, right now, there's what's called a mark-to-market regime, which means that if, Ryan, if you had a company, you're about to go IPO, and you say, you know what, see you guys, I'm renouncing my US citizenship. I don't like your taxes. I'm going to go somewhere else that doesn't hit me up for that many taxes. As soon as you renounce US citizenship, mark-to-market, everything you own is deemed to be sold. So you're going to get a hit tax hit as soon as you renounce. In the old days, I think, let me see, the effective date was on or after June 17th, 2008. In the old days, and I'm dating myself, I started with the IRS in 1995. In the old days, before the effective date of this new 877 Cap A provision, you didn't have an immediate mark to market. So you could somewhat plan. And that really is an area where if you have effective planners, you have options. So there was expatriation. You hear of expatriation and you think sometimes people say, I don't like the politics of the government, so I'm going to leave. I may leave for Canada or Germany or wherever. But I think in this instance, it wasn't that. It was really tax planning at a very, very large scale. And there we got involved, I as counsel, in looking at the transaction to see if it was done properly. Were there problems with it? And of course, the Treasury looks at the issue and says, look, the law says what it says, but if you didn't dot the I's, cross the T's, then you're going to run afoul. You're going to get smacked with tax. In that instance, after a long investigation, they planned properly.